The pyramiding paradox is Jesse Livermore's counterintuitive strategy that dictates a trader should buy high and sell higher. This approach stands in direct opposition to the common, deeply ingrained human desire to seek bargains in the market. Most retail traders are instinctively drawn to purchasing assets when prices are low, hoping for a recovery that validates their predictive power. Livermore understood that this mindset is often a recipe for disaster and prolonged capital stagnation. This paradox is rooted in the idea that confirmation of a trend is infinitely more valuable than prediction of a reversal. When a trader buys low, they are essentially betting against the existing market momentum, or at best, hoping a consolidation phase will end quickly. Livermore's method, by contrast, requires the trader to commit capital only when the market has already demonstrated clear upward movement. This means the trader is forced to pay progressively higher prices for subsequent additions to their position. The goal of implementing the pyramiding paradox is not merely to capture a profit, but to reduce overall portfolio risk while maximizing the profit potential in a confirmed, powerful trend. By constantly scaling into strength, the trader ensures that their largest capital commitments are placed only on proven winners. This method fundamentally shifts the risk management paradigm from guessing where the bottom might be to confirming where the momentum already is. Livermore refused to commit significant capital based solely on speculative hunches or technical patterns that had not yet broken out. He recognized that predictions, no matter how well researched, are inherently subjective and prone to emotional bias. The foundation of the pyramiding paradox is a cold, hard reliance on objective market confirmation. This confirmation only occurs when the price action unequivocally validates the underlying hypothesis of a strong move. Before we dive deeper into the precise mechanics of how Livermore deployed this powerful strategy, please take a moment to subscribe and leave a quick comment below. Even just a single word or emoji greatly helps the algorithm recommend this video to more people who are interested in serious trading education. This simple action shows me that this kind of content truly matters and is worth the extensive research required for creation. Additionally, please do not forget to return to the channel during those challenging times when trading inevitably becomes difficult and your confidence starts to waver. The consequence of demanding market confirmation is that the trader is necessarily compelled to buy high, meaning they must purchase above their initial entry price. If the market is truly confirming a substantial move, the price will be accelerating away from previous resistance levels. Livermore saw paying a higher price not as a penalty for missing the bottom, but as a premium paid for certainty. This premium ensures that the trader is riding the confirmed wave, rather than attempting to catch the falling knife. The core principle centers around the realization that the market will tell you what it intends to do, but only if you are patient enough to listen. Waiting for the market to confirm your directional bias is the ultimate act of discipline in speculation. This discipline prevents the premature commitment of capital into ambiguous or sideways trading ranges. It replaces the anxiety of prediction with the calculated action of response. The entire pyramiding process begins with what Livermore called the scout trade or the pilot position. This initial purchase serves a crucial function. It is not intended to generate substantial profit, but strictly to test the immediate reaction of the market. The requirement for this first trade is minimal risk, meaning the capital committed must be a fraction of the intended full position size. This small commitment allows the trader to enter the market without the emotional baggage associated with a large stake. Livermore often suggested that the initial trade should be no more than a quarter of the total capital intended for that specific opportunity. For instance, if the plan calls for purchasing 1,000 shares, the pilot position would be only 250 shares. This measured approach ensures that if the market immediately contradicts the trade hypothesis, the resulting loss is negligible. The scout trade is purely an information-gathering expedition. The purpose of the pilot position is to see if the stock moves immediately in the desired direction after the entry. Livermore believed that if a stock was truly ready for a major move, it would begin to climb almost instantly following the entry point. There should be very little hesitation or retracement if the technical setup is sound and the underlying trend is strong. If the market does not immediately confirm the direction, the position is liquidated swiftly for a small, predefined loss. Crucially, no further capital is committed if this initial test position fails to move favorably. The small loss incurred is viewed as an inexpensive fee paid for valuable market information. This discipline ensures that the trader never finds themselves trapped in a declining or stagnant position simply because they committed too much capital too early. The test position acts as a low-cost barrier against major errors. Following the successful entry of the scout trade, the next vital step is identifying the point of least resistance, which Livermore often referred to as the pivot point. This pivot point is a clearly defined price level where the existing resistance is expected to collapse, signaling that the stock has truly entered a new, accelerated trend phase. It is the price point where the weight of buyers definitively overwhelms the sellers. The pivot point is typically a significant prior high, a major level of consolidation resistance, or an established point where the stock had previously reversed direction. Breaking this level confirms that the trading range has been successfully overcome, and that the path of least resistance is now sharply upward. Livermore stressed the importance of waiting patiently for this decisive break before scaling up the commitment. Pyramiding is strictly forbidden until the price decisively clears this critical pivot point. Attempting to add to the position while the stock is still consolidating below resistance is a form of averaging up too early, which exposes the trader to unnecessary risk. The pivot point acts as the necessary confirmation signal required to justify the increase in capital allocation. Once the pivot is breached, the market is effectively giving permission to the trader to commit more funds. The breakout must be decisive, meaning it should occur on high volume and with strong momentum, leaving little doubt about the sincerity of the move. A weak tentative break above the pivot point often results in a false signal or a quick reversal. Livermore sought powerful, unequivocal signals that minimized ambiguity in the decision-making process. The clearer the breakout, the higher the confidence in the subsequent pyramiding stages. The identification of the pivot point is perhaps the most critical analytical step in the entire pyramiding strategy. It requires a deep understanding of market structure and historical price action. A trader must be able to distinguish between minor fluctuations and truly significant structural resistance levels. Misidentifying the pivot point can lead to premature scaling or, worse, scaling into a trade that immediately fails. Livermore learned through painful experience that committing large sums before the pivot was cleared was essentially gambling. He understood that the market often tests resistance multiple times before finally breaking through, and he did not want his capital tied up in those frustrating test phases. The pivot point is the line in the sand that separates speculation from confirmed trend following. Furthermore, the pivot point serves as the definitive reference for the initial stop-loss placement. Once the scout trade is entered and the stock begins to move toward the pivot, the stop can often be adjusted to break even or slightly above the entry price. This mechanism ensures that by the time the stock clears the pivot point, the entire position is already protected against significant loss. The transition from the scout trade to the full pyramid structure is entirely governed by the pivot point's clearance. It is the moment the strategy shifts from testing the waters to fully engaging the confirmed trend. The discipline required to wait for this signal, especially when anticipation is high, is the hallmark of a professional trader. The pivot point is the gatekeeper of capital deployment. The magnitude of the pivot point is also proportional to the expected length and power of the subsequent trend. A breakout from a multi-year consolidation will likely lead to a far more significant pyramiding opportunity than a break from a short, week-long resistance zone. Livermore was always looking for the biggest moves, and the biggest pivots signaled those opportunities. This focus on magnitude ensures that the pyramiding effort is only expended on trades with the highest potential return. The scout trade is often initiated just before the anticipated pivot point, allowing the trader to capture the initial momentum of the breakout. If the stock fails to reach the pivot and reverses, the small loss is taken quickly. If it succeeds, the trader is positioned perfectly to add capital precisely when the trend is accelerating. This timing is essential for maximizing the leverage efficiency of the capital. The concept of the pivot point forces the trader to be reactive rather than proactive in their capital deployment. While the trader analyzes and anticipates the direction, the actual commitment of large capital is entirely dictated by the market's action. This reliance on objective price confirmation removes the need for subjective interpretation during the critical scaling phase. It simplifies the decision-making process into a binary choice: clear the pivot or stay out. The patience required in this phase is often underestimated by novice traders who feel compelled to be constantly active in the market. Livermore knew that true profits came from waiting for the perfect alignment of factors. Waiting for the pivot point is an exercise in patience that protects the trader from whipsaws and false starts. It preserves capital for when the odds are overwhelmingly in their favor. The market conditions surrounding the pivot point must also be considered. High volatility near the pivot often suggests indecision, while a clean, powerful push indicates conviction. Livermore preferred the latter, as conviction simplifies the pyramiding process by minimizing the risk of a sudden, sharp reversal. He sought trades that moved cleanly and smoothly, allowing for systematic addition of capital. Once the pivot point is decisively broken, the initial 250 shares are already showing a profit, validating the underlying hypothesis. This profit provides the psychological and financial cushion necessary to execute the next steps of the pyramiding strategy without hesitation. The profit earned on the first segment acts as the insurance policy for the subsequent larger commitments. The success of the first step, moving from the pilot position to clearing the pivot, is the mandatory prerequisite for moving into the full pyramiding phase. Without this confirmation, the entire plan is aborted and the capital is preserved. This strict adherence to confirmation is the protective core of the pyramiding paradox. It prevents the trader from throwing good money after bad. The small initial capital commitment also serves a psychological purpose, keeping the trader's emotions in check during the testing phase. If the commitment were large, the temptation to hold on to a losing position in hopes of recovery would be overwhelming. The small scout trade allows for cold, immediate liquidation if the market confirmation fails to materialize. The pivot point, therefore, is not just a technical level. It is the psychological and strategic boundary that separates cautious testing from aggressive trend leveraging. Livermore's genius lay in institutionalizing this boundary into a rigid, non-negotiable trading rule. The rule is simple. If the market cannot clear the pivot, the trend is not ready, and neither is the trader's full commitment. The entire process ensures that the trader is never caught buying a stock that is simply dead money or consolidating indefinitely. Every piece of capital committed must be actively working and generating profit immediately. This focus on capital efficiency is a direct consequence of the disciplined waiting for the pivot point confirmation. Once the pivot point is cleared and the initial scout trade is comfortably profitable, the trader proceeds to the mechanical execution of the staggered scale. The primary rule here is that the full position must be divided into distinct manageable segments, commonly structured as thirds or quarters. This segmented approach ensures that the commitment is gradual and tied directly to the continued success of the trend. Let us use the example of a total intended commitment of 1,000 shares, meaning the initial trade was 250 shares. The next step is purchasing the second segment of 250 shares. But this purchase is only triggered after specific, predetermined conditions are met. These conditions are always based on a measurable increase in price, confirming continued momentum. The trigger for the second purchase is usually defined by a specific profit margin achieved by the initial segment, such as a 10-point move or the clearance of the next major resistance level following the pivot. If the stock moves up 10 points and holds that gain, the market has provided the second confirmation necessary to justify the increased capital commitment. It is crucial to understand that these 250 shares are purchased at a significantly higher price than the first 250 shares. This necessity of buying at a higher price is the essence of the paradox. The trader is willingly paying more for the same asset. However, they are not paying more because they missed the entry. They are paying more for the increased certainty that the trend is robust. The higher the price, the stronger the confirmation, and the lower the overall risk of a sudden reversal. The subsequent additions follow the exact same rigid process. The third segment of shares is bought at a progressively higher price, only after the first two segments have generated further profit and cleared yet another resistance level. The fourth and final segment is purchased at the highest price of all, representing the peak commitment made when the trend is most mature and confirmed. This structured scaling ensures that the average cost of the total position steadily rises along with the market price. While this might seem inefficient to a bargain hunter, it is the cornerstone of risk management for the trend follower. The rising average cost is a direct reflection of the market's continuous validation of the trade. The trader is always adding to success, never to failure. The core protection mechanism inherent in this method is the concept of the safety net derived from prior profits. Because subsequent purchases are only made from the profits of the previous segments, the capital committed is always backed by a successful trend. If the market reverses, the profits from the earlier segments cushion the loss on the later, higher-priced segments. This mathematical advantage ensures that the total position is largest precisely when the trend is most confirmed and momentum is highest. Livermore refused to speculate on recovery. Instead, he leveraged success. This scaling mechanism maximizes exposure during the most profitable phase of the market cycle, rather than during the uncertain accumulation phase. The largest amount of money is thus riding the wave when the wave is highest. The distances between the addition points must be carefully calibrated to the volatility and typical movement of the specific stock. Adding too frequently on small moves results in unnecessary risk exposure and a rapidly rising average cost without sufficient confirmation. Adding too infrequently might mean missing a large portion of the move. Livermore emphasized using major resistance levels, not arbitrary price points, as the scaling triggers. Each addition point effectively becomes a new, higher stop-loss trigger for the entire position. As the pyramid grows, the stop-loss for the entire block is continuously trailed upward, locking in profits on the earlier segments. This mechanism ensures that the trader is never exposed to giving back a large portion of the move once the position has matured. The rising average cost is protected by a rising stop-loss. The commitment of capital must always be proportional to the overall size of the market move expected. If the stock is highly volatile, the spacing between additions must be wider to avoid being stopped out by normal market fluctuations. This calculation requires constant market observation and adjustment, making pyramiding a dynamic rather than static strategy. The trader must remain flexible within the rigid framework. The psychological benefit of this staggered scale is enormous, as the trader is never forced to make a large, stressful commitment at a single, uncertain price point. The decision to add capital is always validated by the existing demonstrable success of the trade. This removes the element of hope and replaces it with cold, calculated response to price action. The trader's emotions are naturally aligned with the market's performance. The mechanical nature of the scaling process eliminates the temptation to hesitate or second-guess the system once the trend is confirmed. Once the rules are established, for example, adding 250 shares every time the stock clears a 10-point hurdle, execution becomes automatic. This automation is vital for maintaining discipline during periods of high market excitement or fear. Furthermore, the pyramiding process automatically controls the capital exposure of the trader. If the market move is weak or short-lived, the trader will only commit a small portion, perhaps 500 shares instead of 1,000. If the move is massive, the full commitment is deployed, ensuring maximum leverage of the opportunity. The market itself dictates the size of the risk taken. The total average cost of the final, fully built pyramid structure is a critical metric. While it is higher than the initial entry price, it should still be significantly lower than the price at which the final segments were purchased. This spread between the average cost and the current market price represents the accumulated paper profit that protects the position against minor corrections. The paper profit becomes the ultimate safety buffer. Livermore never advocated for reckless scaling. Every addition had to be justified by a clear, sustained upward move. He viewed the market as a series of movements, and he only wanted to participate in those movements that showed the highest degree of conviction. Pyramiding is the systematic monetization of that conviction. It is not an aggressive technique for beginners, but a precision tool for professional speculation. The staggered scale also acts as a defense against unexpected news events. If negative news hits the market, the stop loss on the entire position will be hit, liquidating the successful trade. However, because the capital was built up slowly, the total loss will be minimized relative to the total profit already generated or the size of the position at the time of the reversal. The strategy prioritizes the preservation of accumulated gains. The mechanics of pyramiding are a testament to Livermore's belief that the biggest money is made by patiently sitting tight on winning positions. The process of adding shares ensures that the trader is continuously engaged with the trend, rather than being tempted to take profits too early. Each successful addition reinforces the commitment to the long-term move. The trader must resist the temptation to make the segments unequal, such as buying 500 shares on the second segment, because the stock is moving strongly. Maintaining equal segments, whether quarters or thirds, ensures a balanced average cost and predictable risk management. Deviation from the structured plan introduces unnecessary emotional variables. Consistency in sizing is key to the mechanical advantage. The total commitment should always remain within the bounds of the trader's total risk allocation for that market cycle. Pyramiding allows for full commitment, but only under conditions of maximum confirmation. This contrasts sharply with the amateur approach of committing full capital based on hope and intuition before any confirmation is present. Livermore's method is the epitome of calculated risk. Understanding the pyramiding paradox requires a clear and absolute distinction from its fatal opposite, averaging down. Averaging down is the practice of buying more shares of a losing position as the price falls, with the explicit goal of lowering the average cost per share. This strategy is perhaps the single most destructive habit in speculative trading. Livermore considered averaging down to be the mark of an amateur who is desperately trying to mitigate an initial mistake. When a trader averages down, they are increasing their exposure to a trade that the market has already declared wrong. This action increases risk exponentially because the trader is committing more capital to a proven loser. The market is screaming no, and the trader is shouting yes with more money. Livermore's ironclad rule was unequivocal. A trader should never average a loss. If the initial test position shows a loss, or if any subsequent segment of the pyramid begins to move against the position, the trade is simply wrong. The solution is immediate liquidation, not the deployment of additional capital in a futile attempt to rescue the trade. The fundamental risk profile contrast between the two strategies is stark and absolute. Pyramiding ensures that the largest capital commitment is always made to a winning trade, leveraging success and momentum. Averaging down, conversely, ensures that the largest capital commitment is made to a losing trade, compounding failure and increasing the eventual margin call risk. One strategy optimizes gains, the other maximizes losses. Averaging down is driven by the emotional desire to be right and to avoid admitting a mistake. The hope is that the price will bounce just enough to allow the trader to break even or exit with a small gain. This hope is anathema to disciplined trading, as it replaces objective analysis with wishful thinking. Livermore viewed this emotional attachment to a trade as a guaranteed path to ruin. The mathematical danger of averaging down is that it requires an increasingly large percentage rebound just to break even as the price continues to fall. If a stock drops from 100 to 50, a trader who averages down might need a 50% rise just to recover their capital, while a pyramider would have already exited the trade at a small loss near 95. The recovery required is disproportionate to the initial drop. Pyramiding is the purest form of cutting losses short and letting profits run, which are the two pillars of successful speculation. By scaling up only on confirmed strength, the trader ensures that their focus remains entirely on maximizing the winning trend. Averaging down forces the trader to focus time, energy, and capital on mitigating losses, diverting resources from profitable opportunities. Livermore's success was built on the principle that the easiest way to make money is to follow the path of least resistance. When a stock is dropping, the path of least resistance is down, meaning adding capital to that position is fighting the market. Pyramiding involves aligning capital with the established upward path of least resistance. The market should be doing the heavy lifting, not the trader's wallet. The psychological trap of averaging down is that it feels like a prudent financial maneuver, lowering the average cost. However, in the realm of speculation, price action is the only truth. A falling price signals fundamental or technical weakness, and adding capital to weakness is a display of arrogance, not prudence. Livermore taught that humility before the market is the greatest virtue. The final segments of a successful pyramid structure are bought at high prices, but the trader is confident because the capital base is already profitable. The initial segments act as the protective shield. In averaging down, every subsequent purchase increases the overall capital at risk without any corresponding market confirmation. The safety net is entirely absent. This leads directly to the rule of zero recovery, a critical mandate within Livermore's risk management structure. If the initial test position shows a loss, or if any segment of the pyramid reverses and hits the predefined stop loss, the entire position must be closed immediately. There's no waiting for recovery, no hope for a bounce, and absolutely no averaging down. Immediate liquidation is mandatory because holding on to a failed trade ties up crucial capital and introduces emotional stress that compromises future decisions. Livermore understood that a small loss is merely the cost of doing business, whereas a large loss can be crippling, both financially and psychologically. The market must prove itself immediately, or the capital is withdrawn. The consequence of strictly following this rule is profound for the pyramiding paradox. It prevents the trader from ever being forced to sell lower than the average cost of the final pyramid structure. If the market reverses before the average cost is reached, the stop loss is triggered, and the trade is closed for a profit or a minor loss on the initial segment. If the market reverses after the full pyramid is built, the trailing stop ensures the vast majority of the gains are locked in. The rule of zero recovery protects the integrity of the pyramiding strategy. It ensures that the capital committed only ever participates in the strong middle phase of a major trend. It eliminates the risk of being caught in the early, uncertain phase of a potential reversal that might turn into a catastrophic decline. The discipline here is absolute and non-negotiable. When a trade is liquidated for a loss, Livermore viewed it as a successful execution of a risk management plan, not a failure of prediction. The failure lies only in allowing a small loss to morph into a large one through inaction or averaging down. Pyramiding demands continuous objective assessment, and the zero recovery rule is the ultimate test of that objectivity. The clarity provided by this distinction allows the trader to execute pyramiding with confidence, knowing that the downside is strictly limited to the initial test position's risk. The risk is defined, while the potential reward is open-ended, which is the mathematical definition of a positive expectancy trading system. The pyramiding paradox thrives on this asymmetry. Averaging down attempts to fix a mistake by repeating it, while pyramiding seeks to capitalize on a success by magnifying it. The mental framework required for each is entirely different. Pyramiding requires patience and confidence. Averaging down breeds anxiety and desperation. Livermore chose the path of composure and calculated aggression. The moment a trader considers adding to a losing position, they have abandoned the Livermore methodology entirely. This moment is the defining split between the professional speculator and the amateur gambler. The professional uses capital to reinforce success. The amateur uses capital to repair failure. This distinction must be internalized by anyone hoping to replicate the success of the great speculator. The structure of the pyramid, built step by step, provides the necessary emotional detachment. Each segment is a separate, profitable decision, allowing the trader to view the entire trade as a series of successes rather than one single high-stakes gamble. Averaging down is one long, continuous, escalating nightmare of uncertainty. The ultimate power of the pyramiding paradox lies in its unparalleled capital allocation efficiency. By adhering strictly to the staggered scale and the confirmation principle, capital is never wasted on trades that are merely stagnant or declining. The benefit of delayed commitment is that the full force of the trader's capital is only brought to bear when the trend is confirmed, active, and highly profitable. This methodology prevents the common affliction of having dead money tied up in positions that are consolidating or slowly declining. Capital is the trader's most valuable resource, and Livermore demanded that it be actively working at all times. If a stock is not moving in the desired direction, the capital is immediately freed up for high-momentum opportunities elsewhere. This efficiency maximizes the velocity of capital turnover. When a stock begins a confirmed move, the pyramiding process ensures that the trader is fully invested and leveraged for that specific opportunity. Conversely, if a stock remains flat for weeks, only the small pilot position is tied up, allowing the vast majority of the capital to remain liquid and ready. This strategic patience is the key to maximizing return on equity over time. The pyramiding strategy is inherently selective, forcing the trader to only participate in the clearest, most powerful trends. The requirement for successive confirmations acts as a filter, eliminating marginal trades that might otherwise tempt a less disciplined trader. This selectivity ensures that the trader's focus and capital are concentrated on the few trades that offer the greatest potential returns. The delay in full commitment also protects the trader from market noise and short-term volatility. By waiting for the stock to clear multiple resistance levels, the trader is ensuring that the underlying move is substantial and not just a temporary fluctuation. This strategic filtering reduces the frequency of trades while increasing the overall quality of each engagement. The capital efficiency also translates directly into psychological resilience. Since the trader is only fully invested in trades that are already successful, the overall portfolio equity curve tends to be smoother and less volatile. This stability reduces stress and prevents emotional decision-making, which is crucial for long-term consistency in speculation. Confidence is built on confirmed success, not hopeful exposure. The true genius of the pyramiding paradox culminates in the power of the final sale. Because the pyramid was built methodically on rising prices, the average cost of the total position remains significantly below the final peak price achieved by the stock. This wide margin between average cost and selling price is the engine of maximum profit generation. The strategy ensures that the largest quantity of shares, the full commitment, is held precisely when the trend is strongest and the stock is approaching its maximum potential. This is the opposite of the typical amateur approach, where the trader is most heavily invested near the bottom and sells off shares on the way up, reducing their position just as the momentum peaks. Livermore held the line. The maximum profit scenario occurs when the final selling climax or a clear reversal signal occurs, prompting the liquidation of the entire large position. The trader is selling the maximum number of shares at the highest possible price point before the trend reverses. This disciplined exit is the final fulfillment of the promise of the paradox, buying high to sell higher. The final liquidation must be executed with the same mechanical rigor as the entries. Livermore did not attempt to sell the absolute peak tick. Instead, he waited for a clear, objective signal that the trend had terminated, such as a major reversal day or a decisive break of a key support level. Selling the entire position at once maximizes the efficiency of the exit. The size of the profit generated by the fully built pyramid often dwarfs the profits from the initial segments, demonstrating the power of leverage and scaling. The initial test position acts as a low-risk scout, but the subsequent additions are the profit engines. The entire structure is designed to capitalize disproportionately on the sustained power of a major move. The profitability of this method is directly tied to the trader's ability to maintain discipline during the scaling process and the exit phase. Emotional attachment to the massive paper profits must be avoided. The exit signal must be honored immediately, regardless of the temptation to hold for just a little more. The preservation of maximum profit is the final act of discipline. If you are looking to truly internalize the psychology and strategies that underpinned Jesse Livermore's legendary career, the essential resource is Reminiscences of a Stock Operator. This new edition of Edwin Lefebvre's classic offers a profound analysis of Livermore's mindset, detailing his triumphs and devastating failures. Crucially, this version is supplemented with unique expert commentary and chapter-by-chapter breakdowns that transform his historical experiences into practical, actionable lessons for the modern trader. You can find the link to this indispensable guide in the description below. The entire methodology of pyramiding is a lesson in patience, discipline, and objective reaction to price action. It is a system designed to exploit the natural tendency of strong market trends to persist longer than most traders anticipate. By buying into confirmed strength, the trader aligns themselves perfectly with the market's trajectory, maximizing exposure when the odds are highest. The pyramiding paradox ultimately proves that in speculation, paying a premium for certainty is far less risky than chasing a bargain based on hope. The trader who buys high, confirmed by momentum and structure, is the one who is best positioned to sell higher for maximum, sustained profit. This is the enduring legacy of Jesse Livermore's mechanical approach to market mastery. The final profit realized from a successful pyramid is the reward for months or even years of patient observation and disciplined execution. It validates the strict adherence to the rules of entry, scaling, and exit. It proves that the greatest profits are not found in complex indicators, but in the simple objective reality of price and volume confirmation. The effectiveness of this strategy relies on the trader's ability to avoid the pitfalls of the human psyche, specifically the temptation to predict or average down. Livermore's system is a shield against these destructive impulses, utilizing mechanical rules to enforce rational, profitable behavior. The paradox, therefore, is as much about psychological control as it is about technical execution. The pyramiding paradox remains one of the most powerful tools available to serious trend followers today. Its structure ensures that capital is protected, losses are minimized, and profits are maximized through systematic scaling into success. It is the definitive method for leveraging momentum, ensuring that the trader's largest commitment coincides with the market's strongest conviction. The final word on the strategy is that market success is not about being right all the time, but about making the largest commitment when you are confirmed to be right. The pyramiding paradox ensures that this principle is executed flawlessly, turning the act of buying high from a risk into a calculated advantage for selling much, much higher.